A bank is the only business on earth that can legally create money from nothing. Not print it. Create it. When a bank loans you $100,000 for a mortgage, that money doesn't come from someone else's deposit. It's conjured into existence by a keystroke. The bank types the number into your account, and the money supply of the entire country expands. And here's what nobody told you. Despite having the ability to literally manufacture the product they sell, despite having a government-backed guarantee on deposits, despite having regulators whose job is to keep them alive, banks keep failing. Not small banks. Smart banks. Silicon Valley Bank. Washington Mutual. First Republic. Over 500 banks have failed in the United States since 2001. By the end of this video, you'll know exactly how that's possible. How banks actually make money on your deposits, the invisible spread that generates billions, and the one structural flaw that makes every bank, no matter how profitable, one bad quarter away from collapse. Let me walk you through what it actually takes to own a bank. Because before we talk about profit, you need to understand the machine. There are 3 sizes. And each one has a completely different economics. First, the community bank. Assets under $1 billion. A small-town bank with 3 to 10 branches. Startup cost, roughly $5 to $20 million in initial capital. These banks survive on relationships, the local business owner who needs a $500,000 loan, the family who wants a mortgage. The profit margins are thin but stable. Like a small regional casino in Colorado, $5 million in cost, $2 million in annual profit, 3-year payback. Clean, boring, functional. Second, the regional bank. Assets between $1 billion and $100 billion. Think U.S. Bank, PNC, Fifth Third. These operate hundreds of branches across multiple states. Startup cost, hundreds of millions to billions. They need massive technology infrastructure, armies of compliance officers, and a loan portfolio diversified across thousands of borrowers. Like the Borgata in Atlantic City, mid-sized, $500 million to $1 billion to build, profitable but requires scale to cover overhead. Third, the megabank. JPMorgan Chase. Bank of America. Citigroup. Assets over $100 billion. JPMorgan alone holds $3.9 trillion. These aren't banks. They're financial infrastructure. Investment banking, commercial lending, wealth management, credit card operations, treasury services, revenue streams that have nothing to do with taking deposits and making loans. Like the Cosmopolitan on the Vegas Strip, $3.9 billion to build, multiple revenue engines, and the scale to absorb shocks that would destroy a smaller operator. But here's where the official story crumbles. Because the cost to enter isn't just money. It's the license. You can't just start a bank. You need a charter, either a state charter from a banking regulator or a national charter from the Office of the Comptroller of the Currency. And getting one is brutally hard. The application process takes 18 to 24 months. You need to raise $20 to $30 million in initial capital before you've taken a single deposit. You need a detailed business plan, a compliance framework, anti-money laundering protocols, stress test models, and a management team with decades of banking experience. The regulators can reject you for any reason, and they reject most applicants. In a typical year, the OCC approves fewer than 5 new bank charters. In some years, 0. Then there's the ongoing cost. A national bank pays semi-annual assessments to the OCC, based on its asset size. A $10 billion bank pays roughly $5 to $8 million annually in regulatory fees alone. Plus FDIC insurance premiums, which, after the SVB collapse, were raised significantly. Banks now pay a base rate of 1.5 to 36 basis points per $100 of deposits, depending on their risk profile. A bank with $50 billion in deposits could pay $200 to $500 million per year in FDIC insurance. Think about that. Before a single loan is made, before a single dollar of interest is earned, the bank owes the government, just for the privilege of existing. Under Basel III, the international banking regulations, a bank must hold a minimum of 8% capital against its risk-weighted assets. That means for every $100 in loans, the bank needs $8 of its own money sitting in reserve, earning nothing. For a megabank with $1 trillion in loans, that's $80 billion locked up. Dead capital. Not generating returns. Just sitting there as a regulatory shock absorber. The system is designed to make banks safe. What it actually does is make them expensive, and make the barrier to entry so high that almost nobody new can play. Now let's talk about the numbers you came for. Because this is where the real money lies. The core engine of a bank is something called the net interest margin. The spread? Here's how it works. You deposit $10,000 into a savings account. The bank pays you, if you're lucky, 0.5% interest. That's $50 per year. The bank then lends that $10,000 to someone buying a car at 7% interest. That borrower pays the bank $700 per year. The bank keeps the $650 difference. That's $650, that's the spread. On a single $10,000 deposit. Multiply by millions of depositors and billions in deposits, and you start to see the shape of the machine. Let me walk you through it one reason at a time. JPMorgan Chase holds approximately $2.4 trillion in deposits. Their average funding cost, what they pay depositors, is roughly 1.5%. Their average yield on loans and investments, what they earn, is roughly 4.5%. That's a spread of 3 percentage points. 3% of $2.4 trillion equals $72 billion in annual net interest income. Before expenses. Before losses. Before taxes. Now the cost side. Personnel. JPMorgan employs approximately 300,000 people. Average compensation of $150,000 per employee. That's $45 billion in payroll alone. Technology. JPMorgan spends $15 billion annually on technology. Data centers, cybersecurity, mobile banking infrastructure, AI systems, payment processing. Real estate, branches, headquarters, data centers, thousands of physical locations requiring maintenance, utilities, and security. Compliance and legal. JPMorgan's annual compliance budget is estimated at $3 to $4 billion. That's not investment in growth. That's the cost of staying alive. Regulators, audits, reporting, anti-money laundering monitoring, sanctions screening, all running 24 hours a day. FDIC insurance, deposit insurance premiums, regulatory assessments, billions more. Total operating expenses for JPMorgan, approximately $100 billion per year. Net income, approximately $38 billion. Margin, roughly 15% on revenue. That looks solid. But here's what nobody told you. That 15% margin depends on one thing staying stable, the spread. And the spread is the most fragile number in banking. Because banks don't control both sides of it. Here's where it gets brutal. And this is the part that the mainstream completely gets wrong. Banks borrow short and lend long. That's the entire business model. Your deposits, they're callable. You can withdraw them tomorrow. The bank has to give you your money on demand. But the bank has lent that money out as a 30-year mortgage at 3.5%. They can't call that loan back. The money is locked in for 30 years. This is called duration mismatch. And it is the structural vulnerability of every bank on the planet. Like a casino where every player can demand their chips back at any moment, but the casino has already spent the money building a hotel that won't be finished for 5 years. In normal times, this doesn't matter. Not every depositor withdraws on the same day. The bank keeps a reserve, typically 10 to 15% of deposits, to handle daily withdrawals. The rest is lent out. But in a crisis, depositors panic. They withdraw simultaneously. The bank can't sell its 30-year mortgages fast enough to generate cash. And if it's forced to sell those mortgages at a loss, because interest rates have risen and the mortgages are worth less than face value, the bank eats the loss. This is exactly what happened to Silicon Valley Bank in March 2023. SVB had taken billions in tech startup deposits during the zero interest rate era and invested them in long-term treasury bonds yielding 1.5%. When the Fed raised rates to 5%, those bonds lost value. A 10-year treasury paying 1.5% when new ones pay 5% is worth roughly 75 cents on the dollar. SVB's depositors, venture-backed startups burning cash, started withdrawing. SVB had to sell bonds at a loss to generate liquidity. They sold $21 billion in securities and took a $1.8 billion loss. The market saw the blood in the water. A bank run followed. $42 billion in deposits withdrew in a single day. By the next morning, SVB was insolvent. One weekend. $209 billion in assets gone. The 16th largest bank in America. Dead. This wasn't mismanagement in the traditional sense. SVB was following the textbook: take deposits, invest in safe government bonds, earn the spread. What killed them was the speed of the bank run. In 1929, a bank run meant people lining up outside a building. In 2023, it meant Slack messages and wire transfers. $42 billion left in hours. No reserve can withstand that. So how do banks prevent this? The same way casinos keep you inside the building. They engineer stickiness. Walk into any major bank branch and notice what's missing. There are no interest rate comparisons posted on the walls. No easy access guides to switching banks. The account opening process takes 45 minutes. The account closing process takes longer. And the switching cost, the psychological and logistical cost of changing your direct deposit, your autopay, your bill pay settings, is designed to be just painful enough that most people never do it. The average American stays with their primary bank for 17 years. Not because they love it. Because switching is miserable. And then there's the app. Banking apps are engineering marvels of retention. Push notifications when your paycheck arrives. Gamified savings goals. Credit score tracking. Budgeting tools. Roundup features that move spare change into savings. Every feature is designed to make the app indispensable, so that even when a competitor offers 0.5% higher APY on savings, you don't leave. Because your entire financial life is wired through this app. And the data banks collect on you, that's where the second revenue engine lives. Every transaction you make with your debit card, every credit card purchase, every bill payment, every wire transfer, the bank sees it. They know where you shop, what you buy, when you get paid, how much you save, whether you're profitable as a customer. A bank calculates your profitability through your transaction behavior. Are you a depositor who keeps a $50,000 average balance and never overdrafts? You're profitable, but not as profitable as the customer who keeps $2,000, overdrafts twice a month at $35 per overdraft, and pays 24% APR on a revolving credit card balance. Banks make over $30 billion per year in overdraft fees alone. The customers who can least afford it generate the highest fee revenue. This isn't a side effect of the business model, it is the business model. And then there's the whale equivalent. In casinos, 0.1% of customers, the whales, generate 25% of revenue. In banking, the equivalent is private banking. High net worth clients with $10 million plus in assets. JPMorgan's private bank serves clients with minimum $10 million in investable assets. These clients get dedicated bankers, estate planning, tax strategy, alternative investments, and custom lending solutions. And they generate disproportionately high revenue, not through fees, but through the sheer volume of assets they deposit, which the bank lends out at the spread. A single private banking client with $50 million in deposits generates more net interest income than 5,000 retail depositors with $10,000 each. The bank doesn't need 5,000 customers to justify a private banker's salary. It needs one. So let me bring this together. A small community bank in the Midwest, $200 million in assets, 3 branches, 40 employees, can generate $3 to $5 million in annual profit with a 4-year payback. Clean, stable, boring. A megabank like JPMorgan, $3.9 trillion in assets, 300,000 employees, operations in 100 countries, generated $38 billion in net income in 2023. Only 1/3 of that comes from the traditional spread between deposits and loans. The rest comes from investment banking fees, wealth management, trading, and credit card interest. The winners in this industry aren't the people who own the bank with the most branches. They're the people who understand that the bank is just the front door. The real business is payments processing, wealth management, data analytics, and lending at scale. The people who own the infrastructure, not the people who run the branches, are the ones who keep the money. The house always wins against the depositors. But the house itself is fighting a battle against duration, leverage, and the speed of a bank run. And in the age of Slack and instant wire transfers, that battle gets faster every year. If you want the version of these stories the mainstream gets wrong, the real mechanics, the hidden forces, the second story, hit subscribe. We just dropped our breakdown of the brutal economics of owning a casino. Go watch it. It's right there on screen. You'll never look at a casino the same way again.